How's it going, friends and family? My name is Amos, and we have a stock analysis requested by a viewer like you. And this one's going to be a little different because we're going to be focusing on the stuff that he prioritizes. And it's going to be Marriott Vacations Worldwide, ticker symbol VAC. As you can see on your screen right now, past one trading day, they're up by 2%. We do 5 days, they're up by 4.6%. Past 1 month, up 25%. But I'm going to tell you right now, cherry picking a timeline when you look at the stock price pattern is manipulation, and it allows you to paint a story that you want. Because if we were to zoom out 1 year, then we would see the full picture, negative 38%. Not good, right? Matter of fact, they just reported their Q3 2025 earnings back in November, and look what happened. Immediately afterwards, the stock went on a nosedive, negative 30%. But since then, now they're up 25%. And by the way, Marriott Vacations Worldwide, this is not the same thing as the hotel chain, because that one is going to be ticker symbol MAR. Same brand, but different businesses. As a matter of fact, Marriott Vacations Worldwide, they pay a licensing fee in order to use the brand Marriott. So in this video, we're going to be analyzing this company, calculating an inherent worth for their stock price based on their own numbers. And by looking at all of the facts and information, I guess we'll walk away knowing whether or not Marriott Vacations is a good deal right now, or if they're less than desirable. Now, if that makes sense with you, let's go ahead and get into it. By the way, their total all-time return, predicated upon the share price appreciation without baking in the dividends, is 232%. It looks like they IPO'd back in November 2011. This is something that I want you to keep in mind. The highs and the lows, the peaks and the valleys. Just remember that, okay? So what exactly is Marriott Vacations Worldwide, and how do they make money? So at its core, it's a timeshare resort operation, and it achieves that as a real estate business that opens up fancy properties that you and your wife's boyfriend can vacation at in together in paradise locations with your beer belly and your gut hanging out. You can sunbathe together on the beaches of Hawaii, Indonesia, whatever. So if you're catching my drift, unlike the hotel chains that operate as a franchise business model, Marriott Vacations Worldwide, they're capital intensive, asset heavy, and primarily they make their money as a B2C revenue model. And unlike the old scam model of buying a single property because of a timeshare, Marriott Vacations Worldwide, they sell you points. And for their customer base, I think acquiring and purchasing points makes more sense because you're not set in stone with just one timeshare location. It opens up the entire portfolio for you to utilize those points. So once you gather enough points, you can redeem them for stays at one of their resorts. Kind of like gathering enough tickets at an arcade to win the prize that you want. That's stored behind that glass display window. It's like, oh, I got 50 tickets. Now I want to buy that action figure toy or whatever. But to be a member of the Marriott Vacations Worldwide Club, you also have to pay fees so that all of their properties are maintained and pretty. Not just for you, but for the other customers as well. So it's kind of like HOA fees if you're a homeowner. And as crazy as it might sound, they actually have 700,000 paying customers with a median income of $150,000 and over 120 resorts in their portfolio. So my drift and takeaway from that is they're not trying to cater towards that working class family living in Arkansas, right? They're targeting the top 1 or 5% of Americans that have a lot of discretionary spending, and their lifestyle tends to be more luxurious. They don't mind eating out at a bougie restaurant, and during economic downturns, their clientele and customer base, they're not as affected as the average working family here in the US. And what's interesting about Marriott Vacations Worldwide is that they also operate the Hyatt Vacation Club. Because back in 2018, they bought out another timeshare company and they acquired that business. Now let's go ahead and talk about the recent developments that are surrounding Marriott Vacations Worldwide. So as we learned at the beginning of the video, they just reported their earnings. What's the earnings? That's when a publicly traded company discloses their operations and financial performance for the prior 90 days. And they also give guidance for the future of like, hey, this is what's coming. This is what to expect. This is how much revenue and net income we think we're going to be able to post. Now their Q3 earnings, I mean, they didn't get butchered for no reason, okay? It was absolutely trash. They missed the revenue expectations. They had a decline in their own key metrics across the board of everything. It went down year over year. So consequently, does it come as a surprise that they lowered their fiscal year 2025 guidance? And that's why the stock price got absolutely hammered. Kind of makes sense. But for the past 30 days, the recovery of being in the green by 25%, it looks like the stock market has a short-term memory. And speaking of short-term, the short-term expectation is that their margins will further decrease as they push for improving and upgrading all of their resorts to be modernized. They're labeling this as the modernization program. And one key element of that is instead of doing in-person facility tours for prospective customers, now they're going to be doing and offering virtual tours. And I can't believe that wasn't an option in the past. It's like, what are we doing here, guys? I think the only positive takeaway from their Q3 earnings is that they're expanding their footprint in Southeast Asia, which should theoretically, right, increase their revenue going forward. It looks like in 2025, they opened up a branch in Thailand. Speaking of which, if you're looking for a country where your dollar goes a long way and you can eat like a king and the sights and everything just about Thailand is a fantastic place. I would personally not want to live there. It's too hot, humid, sticky. But to vacation there, dude, you could spend maybe like $25 to $30 a day to eat and feast like a king. I'm not exaggerating. And in 2026, they're going to open up another branch in Thailand, but also in Bali, Indonesia, which I have heard is kind of like Hawaii, but on a smaller scale. And in 2027, this one is kind of weird. I'm not really seeing eye to eye with this one. They're opening up a resort in Nashville, Tennessee. Now let's go ahead and calculate an inherent worth for their stock price based on their own numbers and financials. By utilizing the Amos GARP formula, which is based on their revenue growth, GARP stands for growth at a reasonable price. Then the cheese value per share is going to be $68.23, which, you know, I'm not a gambling man, but I think in the next like 3 weeks, possibly mid-January, I think they'll reach about $60-65 because it looks like their rebound is really happening, right? It seems like every single day Wall Street is forgiving them and they're piling their money back into them. And the price that I would pay with a margin of safety baked in, that way I'm not just buying it at their intrinsic valuation, but with a little bit of a discount baked in, would be around $50.49. They're slightly higher than that right now. And as a reminder, if we take a look at their 1 year situation of their stock price, I think the lowest price was around $44.58. Now they're about $58. I think they're going to be $60 by the end of next week. We'll see. And the next one is another inherent worth stock price calculator that I made, and it's based upon their earnings per share, otherwise known as the profits per share, because through that, we can formulate a PE ratio and evaluation for the stock price going forward. One thing that I have learned as an investor in the stock market for the past 7 years is that the earnings per share is so much more important than you think. Because through the growth of your bottom line per share, that's how much you can raise your dividend growth as well. Right? So if you see a dividend growth rate of like 25%, more likely than not, their bottom line per share, it went up by like 40, 50, 60%. Okay? So if you see a dividend growth rate of like 2% or 3%, look at the earnings per share growth. More likely than not, it's usually flat or it went up by like 1 or 2%. So the higher the growth rate of the earnings per share, the more dividend growth rate you can theoretically see, unless you're Google, unless you're Meta, unless you're one of these big companies that only increases their dividend by like 2 or 3%, even though you have the financials to increase it by a lot more. I'm talking about you, NVIDIA. I know you pay a dividend, but you might as well not, because it's like less than a penny. But anyways, if we turn our focus onto what happened so far this year, Q1, Marriott Vacations, they posted $1.45 profits per share. Q2 was $1.77. And then in Q3, what they just reported in November, it was negative 7 cents of bottom line per share. So they're losing money in order to run the business. And that's because their bottom line, it's taken a $200 million hit right now, but also for the next few quarters because of their modernization program. Also, they're doing impairment charges on several of their key locations, such as Orlando and Hawaii. Meaning, what they're saying is, what they own on paper, like this iPhone right here, they might have bought the materials, the chips, and everything that's included here at like $500, but the valuation is now worth less. So even though it was $500, on paper, they're saying now it's worth $200, so they're taking an impairment hit. So they're not actually losing the cash, but it's on an accounting basis. Financial engineering, financial manipulation is what I like to say. So in Q4, it's really hard for me to generate a forecast, but reading between the lines, because they only give an adjusted EPS, so not on a GAAP basis, generally acceptable accounting principle or practice, I think it's roughly going to be 5 cents of profits per share. Best case scenario, about 10 cents. Worst case scenario, I can see them posting another negative bottom line per share. To the degree of how bad, I don't know. Maybe like negative 10 cents, negative 20 cents. But if we meet somewhere in the middle and say 5 cents, then that would give us a projected EPS for 2025 as $3.20. Now, the first thing that I want to call out is in fiscal year 2024, their EPS, their profits per share was $5.63. So the decrease and the decline year over year is pretty significant, right? And that's why I think their stock price is going on a sell-off, because now they're being reevaluated by Wall Street and big money to be like, okay, I don't think this company should be at XYZ price, but more appropriately, they should be this price. So based on everything that's happening with Marriott Vacations, now I could be wrong, but what I'm thinking is a PE of a 12 when they report their next earnings, which is in February, I think that's going to follow suit. I think right now their PE ratio is also about a 12, but if it continues to stay at a PE of a 12 and they pull off 5 cents of profits per share, which means in February, worst case scenario, I can see Marriott dropping down to about 38.40. Realistically though, I think their PE is going to be elevated temporarily because their EPS will drop from what it is of right now. I think it's like $4.60 down to like $3.20. So that's going to artificially bump their PE ratio. So best case scenario, I can see them being roughly $64, but based on my technical indicators analysis, I do see a line of resistance at that $60 mark. So I'm not saying this is going to happen, but based on the technical indicators, once Marriott Vacations hits that $60, they could go on a sell-off back down to like their median price. But if we're not going to be too cynical and negative, if they penetrate beyond $60 and they go to like 61 or 62, then I think the ceiling is going to be a lot higher, right? They could go up to 70, they could go up to 80. The possibilities are endless. Now, if we repeat this cycle on and on, for next year, just for fun, I'll show you. I think Marriott could potentially hit $52 to about $80. I think somewhere around 60 to 65 is realistic, but based on the trends and what's happening right now, I do think Marriott could hit 60 or 65 in the next 3 weeks, like I said, right? Based on what's happening, because I thought once you get punished like that by the stock market, you usually trade flat. But with Marriott, what's interesting is in the past 30 days, we're seeing a 25% increase. So it's like the money is slowly piling back in. So maybe Wall Street's not thinking of their situation as catastrophically, right? So if we continue this bear case situation, in 2027, I'm seeing a price of about 105 to 143, and you might be like, what the heck is wrong with you? A 75% increase in their earnings per share, and that's because with Marriott Vacations, it's not a smooth, steady, reliable ride, right? Like with most companies in a traditional format and modality, it usually goes up like this, right? In their metrics and their financials and fundamentals. But with Marriott, what I have seen is like sometimes it goes like this, sometimes it goes like this. I'm talking about their financials, and that's why their stock price follows suit. And I think right now, it's their down year of them reporting terrible stuff back to back. And I think based on their own DNA and history, I think the tide will change and they'll start posting some optimistic, positive stories. And I think their earnings per share is going to get elevated. And I think that's because the financial engineering that they're doing right now, I mean, is it going to happen every single quarter, every single year? You know, I don't know, but I want to believe that no, right? Usually when it rains, it pours. If you have bad news, you might as well just let it all out and do it all at once so your stock price can take the hit and then you can recover from that point on, rather than pulling off the Band-Aid really slowly, like reporting bad news here, reporting bad news there, and then over there. I think with Marriott, they just like to do it all at once, like vomit onto the shareholders and onto Wall Street, and then their stock price gets decimated, and then it just rebounds. As we saw in the beginning of the video, their stock price just has those natural highs and lows. So that's why I'm baking in positivity in 2027, and then things will be moderate and normal again in 2028. So based on this panning out, I can see Marriott Vacations being around 144 to 170, but they could also go in the opposite direction and go down to like $20 a share, right? Nothing is a guarantee and nothing is a promise, but if in fact Q4 2025 things go really well for them, because obviously it's the holiday season, right? I don't have a background in tourism and hospitality, but from my elementary understanding, I think a lot of people do go on vacation during Christmas, New Year's, Thanksgiving, and whatnot. So I'm imagining their Q4 should be pretty rosy. I mean, obviously, they're still taking those financial hits. So best case scenario, I can see them posting like 15 cents. If they do, in fact, hit 15 cents of profits per share, then that bumps it up to about $39 to $66 in the next 70, 75 days. But again, I don't want to paint a Bob Ross rosy picture. They could also post negative 20 cents per share. Now, this is all me guesstimating because they only give guidance for their adjusted numbers. So for me to do it on a GAAP basis, I had to do a lot of guesswork. They could also go negative 20 cents. Then that would just demolish the stock price. But I mean, as of right now, they're $58 a share. So obviously this is very bearish. So based on what we are seeing with their stock price pattern and movement, I think right now they're fairly valued. I think at 58, 59, even at like 60, 62 bucks, I think Marriott Vacations, they're not overvalued, they're not undervalued. And then to corroborate with the GARP formula, he's insinuating about $68 based on the earnings per share, somewhere around like 64. So if we made it in the middle and say so like 66 bucks, I think optimistically that's what Marriott could hit in about 2 months or so. But one thing that I want to show you guys is if we look at Marriott Vacations peers in the timeshare business, the first one is going to be travel and leisure. This is the timeshare arm of the business for Wyndham, the brand. Take a look at their stock price pattern, right? Year to date, which is 12 months, 42% into the green. So it's not to say that every timeshare operation is struggling right now. I think that's just exclusively unique to Marriott Vacations, which is kind of weird to see if we do 1 year, 5 years. So travel and leisure kind of gives you a glimpse and a hint at what could happen if the operations improve, right? So taking a look at their numbers, I would argue it's pretty similar to what Marriott is pulling off. About 3.9 billion. And the year-to-year change is about single-digit growth, right? And if we jump on over to vacation, see, they're also posting about $3.3 billion, and the growth rate year over year is also like single-digit. Pretty similar, but the difference is with travel and leisure, if we take a look at their bottom line per share, it's not decreasing. Well, the pandemic is a one-off thing. We'll give them a pardon for that, okay? Blessings be upon you. If we take a look at their bottom line per share, it's only been positive, right? Whereas with Vacation Worldwide, with their bottom line per share, it's only been negative for the past 3 years. So I think the difference is how they conduct their business and the margins associated with running the operation. I think travel and leisure, crazy to say, because Marriott and Hyatt is a higher class and a brand. But to see Wyndham, which is more of like that budget mid-tier hotel chain, obviously it's not the hotel, this is the timeshare arm of Wyndham, to see them be thriving and doing better, to be honest with you, it's kind of surprising. Actually, let's just take a look at the numbers for Marriott individually first, and then I'll compare it back to their peers, because they also have another one called Hilton Grand Vacations, ticker symbol HGV. So taking a look at their revenue situation, I mean, the growth and the trend is going in the right direction. So I would argue that gross sales in the top line, that's not a concern. But I think what is the concern is like this right here, right? 2022, $8.76 of profits per share. But why is it going down every single year? That's why for 2025, I'm also proposing their EPS is going to be somewhere around $3 and whatever cents. To see it go into the red every single year, I think there's no way to spin it or manipulate it. That is a red flag. The revenue situation, I think, is a green flag. And it is a really CapEx heavy company, so I don't think the free cash flow is a fair assessment and take. But instead, let's take a look at their balance sheet, okay? 474 million seems to be stabilized, not really growing. So that's a yellow flag. It's not good or bad. It's like a C kind of evaluation. Take a look at their total debt. Yeah. If your debt situation is getting worse and bigger by the year, you also want to see the cash and cash equivalents on the books be growing alongside, right? But if the cash is kind of flat, but the debt is growing bigger, it is kind of alarming. But I think the more accurate way to digest and analyze whether or not their debt is manageable is through the debt to EBITDA ratio. Now, as a general rule of nipple, I like to see a standard of 3 across the board. Right? But because it's such a capital intensive, asset heavy industry, the timeshares, because they're building out these properties and they're maintaining and renovating, and there's a lot of loans as the name of the game, I think up to a 4 would be acceptable. To see it at a 9.6, friends and family, I think their debt situation is dangerously high. I think at one point in 2017, their debt to EBITDA was a 4, but oh my gosh. To be honest with you, this does not give me a fuzzy feeling in my stomach. And then last but not least, let's take a look at the shares outstanding situation. So it looks like right now, Marriott Vacations, they are buying back the shares. And how do I know that? Because in 2022, they had 45 million shares out. Dude, that's it. There's not that many shares outstanding. Now there's 41.9 million. So that's a green flag. So I think there's a lot of highs and lows by looking at the financials and fundamentals. And last but not least, if we take a look at their dividend situation, a 5.6% dividend yield, really juicy. Payout ratio, surprisingly, it's sustainable, but once they post at $3.50 of earnings per share, this number is going to jump up. It's going to be closer to like a 90% payout ratio, so it is getting up there. The dividend growth rate in line with inflation. But one thing that I do want to call out is back during the pandemic, they did slash and cut their dividend. And that's because people were not allowed to physically vacation at their properties, right? So that kind of makes sense, but it is sad to see them cut the dividend. And now if we jump on back over to their competitors and peers, if you do it right, I think the timeshare business operation can be a good one, right? Let's see. Balance sheet, cash equivalents, $240 million on the books. Take a look at their total debt. $5.7 billion, but it seems to be stagnant and flat. Like, that's what I want to see, right? Not a trend where it's like, that would be no bueno. Take a look at their debt to EBITDA real quick. Debt to EBITDA is a 6, so it is higher than I would like, but that seems to be the normal across an industry. It still doesn't excuse Marriott for having a debt to EBITDA of almost a 10. That's really freaking high. If you take a look at their dividend situation, 12% dividend growth rate, 3% dividend yield payout ratio. This looks phenomenal. But did they cut their dividend during the pandemic? Yes, they did. It went from 50 cents June 2020. They slashed it to 30 cents. Dividend cutter, but it makes sense. They literally could not afford the dividend, right? Because their earnings per share took the hit. And that's why I was saying the earnings per share is that freaking important. It went down to negative $2.97. How the heck can you afford the dividend if you don't have profits? And then if we look at their other peer and competitor, Hilton Grand Vacations, let's just take a look at their stock price pattern. Oh my gosh, their trading multiple is an 81, but their forward trading multiple is a 14. Speaking of which, what was Travel and Leisure? About 11.8. Their forward trading multiple is a 10. So even though they're going up to the moon right now, they're still kind of undervalued. But then again, if you take a look at their historical PE ratio for Travel and Leisure, it fluctuates between like a 15 and an 8, meet in the middle and say 12 or 13. So maybe they are fairly valued. So that's why when you take a look at the PE ratio, it's not a single 20 for everybody. Less than 20 means undervalued. No, certain industries, they trade at a lower multiple, like oil and gas. But anyways, going back to Hilton Grand Vacations, their trading multiple is an 81. That's pretty crazy, but their forward trading multiple is a 14.4. So again, Hilton Grand Vacations, they're in the green by 16% this year. With Marriott, I'm seeing they're in the negative. I'm going to go ahead and make the assumption that their numbers are kind of going to be similar to Travel and Leisure, but not as pretty. So their top line situation is phenomenal. I like what I see here. Again, this is to show you the potential of timeshare companies if operated, if done right, can be good. But it looks like with Hilton, another bougie high-class brand, it looks like they're also seeing the same woes and problems. Their profitability is just decreasing 4% year over year, 84% year over year. So I think Marriott and Hilton, they're seeing the same thing, but their stock price pattern and movement is very different, which is kind of, maybe it's the guidance. Maybe it's the fact that with Marriott, Wall Street hates to hear that they're going to be spending so much money on modernizing their game plan. Because at the beginning of the year, they used to be about $87 a share, and then during the April market-wide sell-off, they were about $58, and then they rebounded and reached a high of about $84.85, and then it went on a sell-off since then, but they are rebounding. But I want to finish evaluating Hilton Grand Vacation, so it's kind of like 3 businesses in one. Cash situation is decreasing. That's not good. Total debt, yikers. That is not good. Take a look at their debt to EBITDA ratio. Debt to EBITDA 8.3. Not good. Take a look at their dividend situation. They do not pay a dividend. So when it comes to Marriott, it's kind of disappointing to see, because I think this is a company with so much potential, right? At their highs, 2021, $188 a share. To see them fall so far from that, it's kind of disappointing, right? I mean, I hate to keep using PayPal as an example, but even them, right, during their highs, they used to be $300 a share, and now they're $60. It's kind of sad, but I think the bigger question is, can they turn things around? Can they start improving their bottom line per share? And to be completely honest with you, I do not know. But what I do know is that I think when it comes to the whole timeshare landscape of acquiring points so that you can use those points to book a stay at whatever paradise resort, listen, I'm not the biggest fan of Airbnb, but I think they could be a huge threat to the timeshare business, because you could book a 3-night stay wherever in Hawaii at a house with 5 bedrooms, 5 baths, or even in Bali, Indonesia, without any of the contractual commitments of a timeshare company. So I do think Airbnb is just one of those things where it's like, man, they're in the rearview mirror competition, but their stock price is also kind of booty hole, right? Past 12 months, 1.8% in the green. That's, and in past 5 years, negative 3%. Not so good. I think it's one of those commonality and themes that's just occurring in the hospitality space. Everyone seems to be kind of suffering right now. But what's my conclusion when it comes to Marriott? I think it's really tough to say. I think on one end, I do want to believe that with enough time, they should recover to the prices that we just saw from the inherent worth calculator, roughly like $65 in the next 2 months. And then in like 2 to 3 years, potentially around 100 something bucks. But that's if they don't continue to run into headwinds. If in fact there's speed bump after speed bump, I'm not trying to be a doomsday sayer, but on the other side of this argument, they could drop down further, right? $30, $20 a share. But the reason why there's a part of me that wants to be optimistic is because if we take a look at their competitor and peer, Travel and Leisure, they do the exact same thing as Marriott Vacations Worldwide, and they seem to be thriving, right? So why not Marriott eventually? Now, obviously, that's a gamble, that's a turnaround play, but will it come into fruition? I don't know. So ultimately, it boils down to whether or not you believe their problems to be temporary, and then they'll just climb back up to 80 to $100, or if you think this is the start of their fall, and who knows, right? Maybe it could drop further. But between you and me, I think what really bothers me about Marriott Vacations Worldwide is that they thrive for a few years, and then they fall off a cliff. Right? They report a terrible year, and then it's a rinse and repeat that cycle. I mean, right now they're kind of stagnant and flat, but it's a cyclical business at the end of the day, because you'll see consistent growth in their top line and then bam, sell off, but that's the pandemic. That one doesn't really count. And then you'll see progressive growth in their top line and then bam, a sell-off. So me personally, if I were to invest into Marriott Vacations, because it's a cyclical company, How I would play this one is potentially to buy the lows and then to sell it at the peaks. Because it seems like whenever they drop down, they recover and hit a peak, right? If you zoom out, it just seems to be the reoccurring pattern. There's peaks and valleys, peaks and valleys, peaks and valleys, peaks and valleys, peaks. Like, I wouldn't buy it in 2019 at $129. But had I bought it at $48, I could sell right here during this tiny peak at $142 or even the big peak at $188, right? And if we zoom in on the valley right here, roughly $76, sell it right there at $100. Do it again, $69, and sell it right there at $99. $53, sell it right there at $84, and then this one was $45, so who knows what the next peak will be, right? Maybe it's $70, maybe it'll be $80. I don't know. So that's how I would potentially play it, but dude, to be honest with you, I have a watch list with about 100 stocks. I always delete companies in order to add a new one. And to be honest with you, this is a company that I used to have on my watch list. I never pulled the trigger and I ended up deleting them about a year ago. So it's a stock that I'm not interested in and I don't want to play the highs and lows that I just articulated. But if I had to, that's probably what I would do. Buy the lows, sell it on the highs. I can't say that it's a buy and hold because I'm getting to the point in my investing journey where I just don't want to invest in cyclical stocks where there's highs and lows. It's just not my cup of tea. I would rather see something that's slowly growing in a reliable pace, right? Slow and steady wins the race. I mean, with like Marriott, I guess it would make sense. I'm sure there's people out here that bought big at $50 and then sold it at $138 and did the same thing like right here, bought it at $62 and you sold it at $188. So I'm not going to say it's wrong, but me personally, I wouldn't want to do it. So what do you think? Do you like Marriott Vacations Worldwide? Do you see hidden value here? What do you think about the timeshare industry? And as a friendly reminder, if you want to request a stock for me to analyze, you can give it a go using the Google form link that's going to be in the pinned comment and in the video description. And having said that, I hope you guys have a good rest of your day. I'll talk to you really soon. Stay safe. Good luck in the stock market and peace.